Today, we're going to talk about what moves the stock price. Simply put, it's supply and demand. Last Christmas, Nike released Kobe Grinches at 180 for retail on the Nike app. Since Kobe is my favorite player of all time, I want a pair. I asked around, and most of my friends are trying to cop a pair. And since I want a better chance at getting them, I asked to use my family's phones to sign up. Unfortunately, too many people are trying to get them and none of my entries were selected. Then, I went on some consignment sites to see how much I have to pay for a pair. For my size, it was 470 minimum. That's over twice as much as retail. The reason Kobe's jumped so much in price is because there are so many people who want them, and Nike only released a limited amount of pairs. In this example, the Kobe Grinches are the stock, buyers like my friends and me are the demand, and the number of pairs Nike made is the supply. Since the supply is way lower than the demand, the price of the shoes more than doubled in the resale market, which is similar to the stock market. If a stock's supply is higher than the demand, the price goes down. On the flip side, if the demand is higher than the supply, the price goes up. So what drives the supply and demand? First one could be news related to the company. In 2020, you don't even need to show that you have the supply chain or factory ready to produce EVs. You can just leak rumors that you're getting into EVs and your stock will jump on the next day. Another news could be that company announces a public offering, which increases the total shares outstanding. And if you remember from last lesson, by offering more shares, the company's value doesn't change. And investors understand that their share value is being diluted and are likely to sell their shares, which increases the supply of that stock. Now, if the investors like the purpose of the offering, they may increase the company's valuation, which can bring the price back up. The next one is company fundamentals. If a company's revenue growth increases every quarter, more investors are likely to be interested. Similarly, if a company gives bad guidance, which is the company's own prediction on its future performance, this will likely cause more shareholders to sell their position. Usually, we find these updates from the ER. The third driving factor could be market or investor sentiment. You may already know about the major indices like the S&P, Dow, Nasdaq, and Russell. An index represents the price movement of a select group of companies. If the index is dipping, that means the companies in that index are being sold off. If the company you are holding belongs to that index, then it is likely to go down with the rest of the group. This is the market sentiment. Some companies belong in multiple indices, such as Apple belongs to Dow, S&P, and Nasdaq. There are other factors that can affect investor sentiment, such as tweets from a celebrity about a certain animal, or another one tweets directly about the stock market. However, they are not always positive indicators. Last one is the economic conditions. These could be, but not limited to, interest rates, inflation, GDP, unemployment rates, or trade wars. A rise in interest rates could hurt companies that borrow a lot of money, usually the tech companies, but could benefit financial sectors which make money from loans. We will have a separate video on market sectors, so be sure to subscribe so you don't miss that. Inflation could cause people to spend less, which means lower revenue for companies. GDP and unemployment rates have similar effects. If GDP goes down and unemployment goes up, the market will likely go down. Natural or health disasters such as hurricanes, earthquakes, or a pandemic are also commonly referred to as black swan events, which can have severe impact on the economy and the stock market.